Now we are going to see 2B in section B, first question. So bond limited is following activity-based costing. The budgeted overheads and cost drivers volumes of the company are as follows. So we have cost pool, budgeted overheads, cost driver, and budgeted volume. So cost pool has material procurement. So for that we have cost drivers, number of orders. So media handling, number of movements, maintenance hours. So they have given straight away what is the cost driver. So the company has produced a batch of 5,200 components AXL6. So its material cost was 2.6 lakhs and labor cost was 4.9 lakhs. So the activities for the said batch orders follows. So media orders 52, movements 36, setups 50. So this is a total. But this activities they have given for that particular batch size of 5,200 components. So now we are required to calculate the cost driver rate that are used for tracing the appropriate amount of overheads to the set batch. So approximate rates to whole number. So here we should not show it in decimal. We should convert it and show it in whole number. Say for example, if any number is coming as 0.66, we need to show it as 1. If it is 0.44, we can ignore. So ascertain the cost of batch of components AXS6 using activity-based costing. So we need to calculate cost for this 5,200 components. So let me get started. So now first we need to analyze cost driver rate. So first we have material procurement, handling, maintenance. So everything I am bringing here. So material handling, maintenance, setup, quality control, and machinery. So these are all the cost pools we have. So for this, they itself given cost drivers. So cost drivers are number of orders, number of movements. So number of mission hours, sorry, maintenance hours, number of setups, number of inspections for this mission hours. So for machinery, it is based on number of machine hours. So this everything they have given in lakhs, so I will be taking it as whole number. So procurement 11.6 lakhs, so 11 lakh 60,000, 5 lakhs 19 lakh 40,000, 8 lakh 30,000, 3 lakh 52,000, 14 lakh 40,000. So now I have to calculate cost dividend. So number of orders is 2,200. So 11 lakh 60,000 divided by 2,200. So we will be getting 527.27. So I will take it as 527. So here 1350, number of movements is 1350. So 5 lakhs divided by 1360. So this is 367.64. So I will make it as 368. Then maintenance 16,800. So 90 lakh 40,000 divided by 16,800. So 115. So 8 lakh 30,000 divided by number of setups 1040. Then 3 lakh 52,000 divided by 1,800. 14.4 lakhs divided by 48,000. That is so 30 rupees. So here I will be making this 196 and 798. So this is the cost driver rate. So now I have to calculate overage charge to that particular batch. So overage charge to the batch. So here material procurement for this particular batch I am having 52 orders, right? So here I have calculated 527. So 52 into 527. Material handling, material movements, that is 36 into 368. So 36 into our cost ever rate 368. Then maintenance 1380, that is 115 into 1380. Hope this is clear. Setup 798 into 50. Quality control, that is 196. We have cost driver rate, we have already calculated, into number of inspections, it is 56. Machinery 3600. So 30 into 3600. So if I am multiplying this, I will be getting a total overhead of 3,58,228. So what is my ask now? So cost driver rates I have already calculated. So cost of batch of components I need to calculate. So so 5,200 components. So first we have direct material. So direct material has, they have given 2.6 lakhs and material is 4.9 lakhs. So 2,60,000 direct labor 4,90,000 they have given. So this together put together we will be having prime cost. So prime cost is 7,50,000. So now I'm adding that overheads, that is 3,58,228. So my total cost will be 11,08,228. So this is a simple question relating to ABC costing. Hope this is clear. So let's move on to next question. So for problem number three, I will put it as a separate video since it is an big question. I will put it as separate video. So let's go to fourth one. So problem number four. 4A now we will see. RNS Limited, a manufacturing company, has introduced a new product and marketed 20,000 units. So variable cost and profit of the product is 20 and 4 rupees respectively. So fixed overheads of 3,20,000. So analyze the BEP in quantity. So they have asked in quantity and margin of safety in amount. So margin of safety in rupees we need to show and BEP in units we need to show. So and calculate the margin of safety if profit is 64,000. So this is again if profit is 64,000, what is the margin of safety we need to calculate? So first I will come to first point. So what is the formula for BEP? That is fixed cost so for BEP in units, straight away I can use in units. So formula is fixed cost divided by contribution per unit, right? So we need to calculate contribution then. So here, do we have selling price? Actually, we don't have direct information for calculating selling price. So we need to calculate the selling price. So how we can calculate selling price now? So first, I will be calculating selling price. See how we can calculate selling price will be your total cost plus profit. So this will come to sales, right? So here can we calculate total cost? That is total cost is variable cost plus your fixed cost. So variable cost, they have given variable cost per unit as 20 rupees and the number of units is 20,000. So 20 into 20,000. So we will be getting 4 lakhs and fixed cost is they have given 3,20,000. So profit, they have already given profit as 4 rupees per unit respectively. So 4 into 20,000, that is 80,000. So then my sales will be 4 lakhs plus 3,20,000 plus 80,000. So 8 lakhs is my sales. So I required selling price, right? That is selling price per unit. So I can make it as 8 lakhs divided by number of units, that is 20,000 units. So I will be getting 40 rupees per unit. So now what is the contribution? So my formula is fixed cost divided by contribution per unit. So fixed cost I am having, so I need to calculate contribution per unit. So that is sales minus selling price minus variable cost is my contribution per unit. So 40 minus variable cost is 20. So I will be getting contribution as 20 rupees per unit. So now let's apply in BEP formula, that is fixed cost divided by contribution per unit. So fixed cost we already have 3,20,000 divided by 20. So we will be getting 16,000 units. So this is a simple question. Okay, let's calculate margin of safety. So margin of safety in amount they have asked. So margin of safety's formula is total sales minus actual sales, right? That is actual sales minus BEP. So here I am considering BEP in value. So BEP in rupees. So how I can calculate straight away? I can calculate 16,000 here. BEP in units into selling price. So BEP in units is 16,000 and selling price is 40. So my value will be 6,40,000. So I already calculated sales. It is 8 lakhs minus BEP value 6,40,000. So I will be having 1,60,000 as margin of safety. So hope till now it is clear. So then calculate the margin of safety is profit is 64,000. So they have asked what will be the margin of safety if profit is 64,000. So we can use another formula like we have two formulas for calculating margin of safety. That is one is sales minus BEP. Another based on profit we can calculate profit divided by PV ratio. So here we need PV ratio. Profit they itself given that is 64,000. So profit is 64,000 they have given. So now I need to calculate PV ratio. That is contribution by sales into 100. So here in this problem contribution we have 20, sales is 40 into 100. So we will be getting 50 percentage. Okay, as PV ratio. So now I am applying in this formula, that is margin of safety is equal to 64,000 divided by 50 percentage. So 1,28,000 I will be getting. So that is 1,28,000 rupees. So next, coming to third point, if the selling price is reduced by the company by 10%, demand is expected to increase by 5,000. Okay, analyze its impact on profit, BEP in quantity, and margin of safety in amount. So they are asking to analyze the impact. Okay, first let's we calculate what is profit, BEP, and margin of safety for selling prices reduced by 10%. So selling price reduced by 10%. That means existing we have 40, right? So 40 minus 10%, it is 4 rupees. So we will be having new selling price as 36 rupees. And number of units. So already we have existing as 20,000 units. Now it is increasing to 5,000 units. So now we will be having 25,000 units. So what is the profit we need to calculate? So sales, that is 36 into 25,000 units. Remember here we need to change. So 9 lakhs we will be getting variable cost. So variable cost we have 20 rupees per unit, right? So 20 into 25,000. So I will be getting 5 lakhs. This will be my contribution. So 4 lakhs will be my contribution. So I will reduce fixed cost in this fixed cost. There is no mention about changes in fixed cost. So let us assume this 3,20,000 itself. So remains same. So profit will be 80,000. So if I am comparing here, my previous profit also 80,000, here also 80,000. So profit remains same. Even there is a reduction in selling price. Because of increase in units, okay? Units increasing, that's why profit is remaining same. Increased number of units or increased sales units. Number of units sold you can use. Then we need to calculate BEP now. So BEP in units I'm calculating, that is fixed cost divided by contribution. So fixed cost is 3,20,000 divided by my contribution per unit, right? So here I will be calculating contribution per unit. So that is 4 lakhs divided by 25,000. So per unit will be 16 rupees. So 16 if I am putting, I will be getting 20,000 units. So earlier my BP is 16,000 units. Now it is increased to 20,000 units. So BEP increased to 20,000 units from 16,000 units. Fine. Then margin of safety I need, that is sales minus BEP. So BEP in rupees I need, right? So I will be calculating BEP in rupees. So BEP in rupees is 20,000 units into selling price, that is 36. We need to use 36 only for this. So 7,20,000. So here sales is 9 lakhs. So 9 lakhs minus 7,20,000. So I will be getting 1,80,000. My existing margin of safety is 160. Now it is increased. So margin of safety increased to 180 from 1,60,000 rupees. So this is analyze we should write, because in question they have clearly mentioned analyze its impact. So we need to analyze the impact. So marks will be given only if we are writing this analysis. Even though if you are calculating this one, we won't get marks unless we if we have written this analysis. Hope this is clear. So coming to next question. So for B, Kautilya Limited currently working at 80% capacity as the following particular. So sales, direct materials, labor, variable overheads, fixed overheads, and export order has been received. That would utilize half, that is 50% of the capacity. Now we are currently working at 80% capacity. So what will happen if I'm taking this 80 plus 50? It will go to, so 80 plus 50. This will comes to 1,30,000, right? So we need to do something because our maximum capacity will be 100. So let's see what we can do. So the order cannot be split. That is, either it is to be taken in full and executed at 10% below the normal domestic price, or be rejected totally. So, if we are taking this order, we can take this entire 50%, or we can reject entirely. So, for this export order, selling prices less than the normal domestic price. That means uh, we need to sell at 90% of domestic sales price. So, the alternatives available to the management of the company are reject the order and continue with domestic sales only. That is at present value, right? So first we will see what is this point. So now I am preparing statement of profitability comparison, comparative profitability statement I am preparing. So first we are rejecting the order. That is now we are having only 80% as domestic, right? So here sales, that is domestic. So domestic we have 48 lakhs. So here I will be bringing export sales and then total. So here direct material. So direct material they have given 15 lakhs and labor as 6 lakhs. I will be preparing based on margin customer details. Variable cost everything I will be bringing first so that I can calculate contribution under. So fixed overhead 3 lakhs. Sorry, variable overhead. So this all together will come total variable cost. So 24 lakhs. So my contribution will be 48 lakhs minus this 24 lakhs. It is 24 lakhs is my contribution here. So less fixed overheads. So fixed overheads they have given 19 lakhs. So profit is 5 lakhs. So we are having a profit of 5 lakhs in existing. That is, we are rejecting export fully and we are continuing with existing order only. So accept the order, split the capacity 100% between overseas and domestic sales and turn away excess domestic demand. So we can turn away the domestic demand only because export order cannot be splitted, right? So I can't execute 20% and all in export order. So if I'm accepting this 50% capacity, I can do domestic also 50%. So accepting results to export is already 50% occupied, right? So my total capacity is 100. So the remaining 50 will be going for domestic. So now I will be calculating domestic is 50% and export is 50%. So I need to calculate the cost for this 50% capacity. So sales, if I'm coming to sales at 80% capacity, I'm having a sales of 48 lakhs. So what will be for 50% capacity? I need to calculate this. So how I will calculate? This is 48 lakhs divided by 80 into 50 I can calculate. So for domestic there is no change. So I can use 30 lakhs itself. For 50% domestic sales, I can use this 30 lakhs as it is. But for 50% export sales, I need to reduce the selling price to 10%, right, below the domestic price. So 30 lakhs into 90%, I can say. That is after reducing this 10%. So how much we will be getting? 27 lakhs. So my domestic sales will be, so my domestic sales will be 30 lakhs. My export sales will be 27 lakhs. So total sales is 57 lakhs. I hope this is clear. So now if I am coming to material, so material here we need to convert this for 100%. It is 15 lakhs is for 80%. So divided by 80 into 100. So I will be getting 18 lakhs 75,000. Same way for direct labor, 6 lakhs into 100 by 80. So 7 lakh 50,000. So and for same way overheads, that is 3 lakhs into 100 by 80. So I will be getting 30 lakhs. So here contribution 57 minus 30, 27 lakhs. So overheads remains same. So there is no change in overhead. So because irrespective of units change, overheads remains constant. So total overheads remains constant. So I will be bringing 19 lakhs as it is. So profit will be 8 lakhs. So in this case, profit is increasing to 8 lakhs. So hope this point is clear. So now coming to next point, increase capacity so as to accept the export order and maintain the present domestic sales. So that means if I want to maintain the present domestic sales of 80% plus export order is 50, it will come to 130. So I need to increase my capacity to my overall capacity is 100, right? So I have to increase my capacity by 30%. Then only I can do this. So what I am doing here, buying an equipment that will increase capacity by 10%. So I am buying an equipment so that my capacity will be increased to 10%. So that means now at present 110% will be there. So for remaining 20%, I need to search for some alternatives. So this will result in an increase of 1,50,000 in fixed cost. So existing fixed cost is 19 lakhs, right? So 19 lakhs plus 1.5, that is 20.5 lakhs is my new fixed cost. So work overtime to meet balance required capacity. What is the balance required capacity? That is 20% as we already discussed. In that case, labor will be paid at 1.5 times the normal wage rate. So usually we are paying at 1 times, right? So if it is working overtime, we need to pay extra. That is 1.5 times. The half time is extra. This will come as your overtime charges. So we need to calculate all the expenses now again. So here, if I am working 80% domestic and export is 50%, my existing domestic sales remains constant, right? So the sales remains constant. So for our 50% already we have calculated 27 lakhs. So hope this is clear. So that is 48 lakhs plus 27 lakhs. So we will be having a total sales of 75 lakhs. Now coming to material. So material, uh, so 15 lakhs into 130 by 80. So 24 lakh 37,500. So material is very simple. So coming to labor. So direct labor. This direct labor is already we have 6 lakhs for 80% capacity. So till 110 percentage, there is no need for us to pay over time. So what is this is for 80 percentage. So now I need to calculate for 110 percentage. What will be my direct labor? So 6 lakhs into 80 by 110. So I will be getting, sorry, just a second, into 110 by 80. So 8 lakh 25,000. So for balance 20% capacity, I need to pay premium, right? Overtime premium I need to pay. That is 1.5 times I am paying. So that is 6 lakh 20,000 divided by 80 into 20%. Here I am paying 1.5 times. So into 1.5. So this will comes to 2 lakh 25,000. So my total direct labor will be 8 lakh 25 plus 2 lakh 25. That is 10 lakh 50,000 will be my total labor. Labor at 130% is 8 lakh 25,000 plus 2 lakh 25,000. That is 10 lakh 50,000. So here I have to mention as 10 lakh 50,000. I guess this is clear. So now again coming to variable overhead. So variable overhead is 3 lakhs into 130 percentage divided by 80. So we will be getting 4 lakh 87,500. So now the total variable cost will be 39 lakh 75,000. Then contribution is 35 lakh 25,000, that is selling price minus contribution. Now here fixed cost we have already noted it as 20 lakh 50,000. Now I have to take it as 20 lakh 50,000. So profit will be 14 lakh 75,000. So at 130% capacity, our profit is very high. So we can, so here prepare a comparative statement of profitability and suggest the best alternative. So suggestion is alternative 3